I've been trading UK stocks for a living since 2016, and in that time I've made a huge amount of mistakes, from pressing the wrong buttons on the platform to even buying the wrong stock, but some of them are so big that they stand out like me in a bodybuilding contest and deserve to be acknowledged. And if you stick around for the rest of the video, I'll show you the one single thing that I could have done to more than triple my profits on a single trade and how you can take advantage of it in the future. But first, to give you a little context, it was a seemingly uneventful day on the 14th of May in 2018, and looking at this day, I imagine it probably means nothing to you unless it's your birthday. But this was the day the Supreme Court in the United States legalized sports betting and overturned the 1992 Professional and Amateur Sports Protection Act, which prohibited sports gambling. And this was huge because it meant an entire nation of around 300 million people would now potentially be able to banana their wages on gambling, which meant the gambling companies would likely see a lot of money coming in from a country where gambling was previously outlawed. And I knew about this from Twitter. I actually knew that in the Supreme Court's meeting this was up for debate and potential repeal. So when SCOTUS overturned this ruling and legalised sports betting, I bought as much as I could of a small micro-cap stock called Webis Holdings, which at the time had gambling licenses, and so the company's fortunes had materially changed for the better. And this is what happened to the stock's share price. So I managed to buy in around 1.3 pence and sold the last of my stock the day after at 5.8 pence. So I did capture a more than 300% move in the day, and this was a big return for me. However, it could have been a lot bigger had I used this edge and exploited the information properly. The issue was I basically bought a micro cap that had thin liquidity and therefore stock was a lot more limited. But here are the charts of the bigger gambling companies such as William Hill and 888, and you can see that once the news was announced, these stocks didn't go into auction straight away. They started ticking up slowly and kept on climbing throughout the day. So I could have bought all of these companies in much bigger size and just held for the rest of the day, and it would have been a much bigger payday. With the larger companies, there was a lot more liquidity and actually a better risk to reward on the trade because the spread was way tighter, and if I was wrong on the trade I could easily exit, whereas with Webis I was relying on heavy volume coming into a micro cap to spike the price. So the lesson for me there was that I had the right idea and I had the right trade, but I could have played this trade more effectively using different instruments as well. The second biggest regret of my trading career was in 2016, but this one also inspired me and motivated me because it showed me what was possible in the market. So I'd been searching for low price to earnings ratio stocks to try and find quality stocks, and I ended up coming across a stock called Crichton's. And this stock was, and still is, a cosmetics business that had been through a rough patch and was now profitable and growing its revenues and earnings at a steady pace. Now I bought in around 7 pence, and everyone who I spoke to about this stock, they didn't like it, they weren't interested or bothered and wrote it off. And because I was relatively new to the stock market, even though I'd read the reports, gone over the financials and understood the history of the stock, I was still unsure of myself and I just assumed everyone else knew best. About 6 months later the stock got to 14 pence and I sold for a 100% profit thinking I'd got lucky, only to watch the stock hit 45 pence just a year later. So I was actually right, and because I didn't back myself I missed out, and although the profits were small because my account was small, it did teach me to trust my own research, because if someone's bullish on a stock, they'd own it, and if they don't own it, they'll always view it negatively. So I'm not saying ignore people, because maybe there's some genuine points and red flags being raised, and you should definitely seek opposing views on stocks you own to test your own thesis. But if you've considered these and still think the stock is a buy, then trust your instincts and hold the stock. But that was nothing compared to the next missed opportunity, which was a day that we all knew would come. And at 11:45 a.m. on the 9th of November 2020, I was watching Games Workshop and I saw a spike on the 1 minute candle along with large volume. I wanted to check if this was stock specific, so I looked at Vodafone and International Consolidated Airlines Group, and both of these were rising on high volume too. So I instantly knew big positive news had dropped into the market, so I went long a basket of leisure and hospitality stocks and tried to buy some airlines. And then I found out there was a vaccine, and unfortunately I just wasn't prepared enough. I hadn't taken the time to actually think what sectors would be the best longs and shorts, and of those sectors, which specific stocks. So when the news dropped, I was scrambling around buying stocks quickly when I should have had a methodical list to work through. I also didn't fully understand just how significant the vaccine news was, so I didn't go max long, and obviously this was the catalyst for the huge bull run we saw throughout the whole of 2021. So I could have and should have done a lot better here and learnt my lesson to always be prepared. But whilst that was a big regret, it doesn't compare to this one. I've talked myself out of plenty of shorts because I've mistakenly assumed that people knew more than me or had done more research. And I've always said that the market isn't efficient, but sometimes I've made the mistake of assuming that the smart money actually know better. A good example was the COVID crash. I remember a friend met a hedge fund manager in December 2019, and he said he was all in short because of coronavirus, and he must have been sweating bullets because the market continued rallying in January and it went even higher in February. And I remember thinking to myself that now would be an excellent risk to reward trade, because clearly coronavirus wasn't priced in. It was sweeping through Italy at the time, and if I was wrong I'd take a small loss, but if I was right I'd be hugely in the money. And I talked myself out of this short because I assumed that the global hedge funds would have priced this risk in, and it was clearly nothing because markets were going higher. And as we know it, it wasn't nothing, because eventually one day the market woke up and started tanking, and because the move had started I was hesitant to get short, worrying about a snapback rally. But clearly, even at the highest levels, the market wasn't efficient, and so that was a big lesson for me. But unfortunately, I didn't learn it well enough, because a year later I got shown an investor deck for a company called Parsley Box, which did ready meals for OAPs, and this looked like a terrible business, and it was listing at a ridiculous valuation, and I thought this was a huge short. But the fact that institutions were buying in made me think twice, and in the end I just didn't put the trade on. And within less than 24 months it had gone spectacularly bust. So my lessons here were the market is generally efficient at the highest levels, but not always, and that institutions are not smart money. Some of them just write a ticket without doing much due diligence. After all, it's often not their money, so they don't care as much. And you can't assume that fund managers know everything, because they don't. Now, I spoke about the COVID crash earlier, and once I realised the market was in free fall and not coming back up, I started shorting anything and everything. And I did well because some stocks created hugely and you'd hit the bid and there was no bid. So every time I sold, the price would fall, and sometimes it would trigger a much bigger fall, like in Hollywood Bull. But I realised my mistake here because a friend of mine didn't bother with individual shorts and just went heavily short the S&P 500 and the FTSE 100. So that meant only 2 sets of commissions, 2 instruments, and 2 instruments that were massively liquid, and so he wasn't constrained for liquidity. It was just a much cleaner and smarter way to play the trade, and taught me in future when there's a big macro event to not ignore the indices and don't only focus attention on stocks. Please let me know in the comments what the biggest trading or investing regret you've had so far in your career, and a like and subscribe are appreciated because it helps me and the channel. Thank you very much for watching, and I'll see you in the next one.